Now, the rapid rise in interest rates over the last year or so has had a significant impact on the increase in resulting holding costs and the cash flow affordability of investment properties generally. So how can you balance the needs of securing high growth properties while making them affordable enough to hold long term without biting into your salary or savings or hamstringing your lifestyle? Well, to reinforce what's important from an investment perspective and to open your eyes to opportunities to manage your cash flow more affordably, particularly during high interest rate periods like we're experiencing, we're joined by our show favourite, Rasti, the author of the Property Wealth Blueprint and the founder of leading national buyers agency, Get Rare Properties. So welcome back to Realty Talk, Rasti.
Thank you so much. It's an honor to be back with you, Bushy.
Always like having a chat to you, mate. You've got well, in your name says it all. You've got a very rare approach to looking at investment property, and in this particular exercise, given the challenges that a lot of investors are having around the increasing holding costs of property, it's a great topic to jump into. But sort of to kick into that, Rusty, why is capital growth critical? And as an aside, why does cash flow need to be managed carefully?
Now, great question there. So first of all, let's understand why people invest. Typically, people invest for the simple reason that they can create wealth. And the creation of wealth can only happen when you invest for, say, for example, a dollar, and you're expecting it to become $1.25 or $1.50, eventually basically making your dollar working harder for you to get your 25 or 50 cents in the piece. So in property context, if you're talking about a property purchase of $500,000 and we're expecting it in a few years' time going to $750,000 and you're making a capital gain of $250,000, this is the prime reason why people tend to invest. And probably I would argue it should be the reason people should be investing, especially just like stock market, residential market is also a growth asset. So when it is a growth asset, we should be investing for the growth. That's why it is important. That's why people invested for that. But having said that, cash flow management is super critical in this particular asset class, especially because of the reason of the leverage that we are taking in this asset class. And what it means is that we are borrowing money from the bank, from the lender, who's charging us interest rates. Now, when we have a loan against a property, yes, there's a capital growth happening, which is probably on the paper that the growth of the property is happening. But in reality, our owner, the property owner, might be actually feeling the pinch of more outgoings than the incomings. Of course, we are collecting rent, and there are lots of expenses around it, like a property management and whatnot. And then there is, so we are taking some incomings as the rent that we are collecting, and there's outgoings. When there's a differential, when there's more outgoings than the incomings, that means someone is out of the pocket. Now, if we are not really managing that out of the pocket money, then it becomes too hard for the property owner to the extent that it becomes unaffordable. And from the experience of working as a buyer's agent, we have seen so many people having that due stress, especially with the interest rate hikes that we have seen over the last year or 15 months or so. It has just become so unaffordable for them that though they wanted to hold the property for long term, they have no choice but to let it go as a distressed seller. So yes, capital growth is super critical, but more important, we can't really miss out on the importance of the cash flow management, because that's a daily routine cash flow management that one has to go through.
Absolutely agree, Rusty. And I guess, you and I are very active with investors every day of the week. I think a big reason why over 50% of first-time investors sell a property within the first 5 years is they haven't paid enough attention to the actual ongoing week-to-week cash flowing of the property, and suddenly it's costing them a lot more than I expected, and they knee-jerk and make a decision that has long-term unfortunate consequences for them. So I think that cash flow affordability piece is something that a lot of investors need to pay a lot more attention to understand what the true actual holding cost of a property is when all of the purchasing and ongoing holding costs are factored into the mix. But sort of coming back to this then, given that interest rates have increased, how can we better manage the shortfall to maintain that ongoing cash flow affordability, Rusty?
Yeah, sometimes I would say that sometimes a bit too late, because the property has already been purchased. Because one of the argument I would say, just like you mentioned here, that 50% of the first-home buyers, first-home first-time investors actually sell the property back because they have actually bought the wrong property or the wrong type of the property, or maybe paid too much. So for someone who's actually starting, I'll probably have a certain suggestion out there that to be mindful of the real true holding cost. And there are certain ways to be mindful of, and also some deliberate action a property investor can take. One is that, of course, like buying the quality property, like making sure that, so let's talk about the components of holding costs. That would really probably help us understand more. So the biggest component of that is that of the interest rates that we are paying, or the loan that we are repaying on a monthly basis.
Yeah.
Second part of it is any expenses around the property in terms of maintenance that we are paying. And the third component would be the incomings, making sure that the incoming as a rent that we are collecting is consistent, more so than otherwise. So of the three components, if I really talk one at a time, so for example, interest or the repayment that we are making to the bank, the first approach would be much more easier to simply go and start thinking about paying interest-only loans.
Yeah.
Now, of course, this can't really stay there for long because there's a regulation there, like banks can't really allow you to hold interest-only loans forever, unlike last time. So whatever we can afford to, going for our interest-only period, it's probably one of the ways to think about it. Of course, it also comes down to the renegotiating the loan rates, talking to your mortgage broker, talking to your bank, because that's an easy win. Just picking a phone to your mortgage broker, asking for a better rate, or debt consolidation, things like that can really happen. Second part of it is getting lowering your maintenance cost around it. And that's really comes down to the quality of the property purchase, also the quality of the property manager. Yep. So always think of property investing as a business of yours, whereby understanding that the property manager, your mortgage broker, your tenant, they're all stakeholders in your business. Yep. Now, when you have picked the right business partners, like property manager, they should be not just going there to collect rent, but rather managing the property truly on your behalf. And what it means is always reporting back, even if the slightest issue or any arrears that the tenant is making, reporting it back and be more, I guess, proactive in looking after them, rather than letting, so for example, a moisture in the bathroom, letting it slip through and then it becomes a big expense, as an example. So if you can lower down the holding cost, it's probably one of the best ways. And that really comes down to the property manager, because that's their duty to do it.
Yeah.
The third part of it is basically making sure the rent is coming consistently. It's again the duty of the property manager, and also sometimes property manager can only do enough. Sometimes the consistency of the rent that matters, rather than becoming greedy and going for extra $10, $20, rather than going for the quality tenant who's taking care of the property, making sure that they are treating it as their home, rather than just a property they're living in. And then that due care also means lower vacancy rate in that property.
Yep.
Now, all of this is possible when we have actually done the right research, we have bought the right property, and there's always, I guess, the vacancy rate, that there's always a good tenant ready to replace your existing tenant. So a lot goes around buying the right side of property. Yep. So that's one aspect of it, basically. Second part of it is, in the days like this, when interest rates has gone up, there's not much people can do. Second part of it would be to really build up build up more of a cash buffer.
Yeah.
Because what really we are saying is, for example, for example, 24 months ago, the outgoings were only $200 per month, which was very easily affordable. But now they have really gone up to, say, $1,400, $1,500 per month. Yep. And if it's still okay for a property owner having only one property, imagine that person having 3 or 4 properties. That's really facing the heat of this unaffordability issue. So second part of it would be really building up a lot more safety net. Yeah. Making sure that there's always some money in the kitty whenever there's some issue with the outgoings going too far ahead. And the third part I would also say is that let's make sure that we always have this money in terms of the safety net. And it might also mean that for someone who's buying a property now in this market, taking the advantage of the supply-demand imbalance that we are really seeing, which is probably, in my opinion, one of the best time, again, the way it is all, with the population rise and low construction numbers that we are seeing through, this is probably one of the best time and making sure that we are buying it right. We are really making sure that we have the enough safety net. And then maybe it also might mean that really paying LMI, which is the short for lender's mortgage insurance, instead of paying 20%, avoiding LMI, because lots of people psychologically think that, oh, I should really save 2%, which probably most of them are right or wrong. I'm not too sure. But when it comes to personal finance, it really comes down to the risk of investing versus risk of not investing. And when they really hold too little money in their pocket in order to save that 2% of LMI, I would actually argue that LMI is not just the insurance for the lender, it's also serving as a very good insurance policy for the borrower, because it's really serving as an extra 8% or so extra money in the kitty. So buying it well, maybe keeping a lot more money for themselves as for the safety net, even it means less upfront cost, maybe as a virtue of paying LMI. And also maybe if it's getting too close as a number, then maybe we should be thinking about lowering the budget at the upfront, so that the upfront costs are low, so that we can really increase our safety net, if that makes sense.
Absolutely. You make some very good points there. I totally agree with you on the LMI front, because if you're borrowing money for investment, then the LMI is actually tax deductible, and a good accountant can write that off in between 1 and 5 years, depending on how they decide to treat it. So having that potentially extra 8% of equity they can access, and then potentially using that additional funds almost like a tax deductible rainy day reserve, so that if you've got an interest only loan with extra capacity in it over and above what you physically need to purchase the property, and that becomes your reserve, then one, it's tax deductible. Two, it doesn't cost you anything if you're not using it. But when an issue occurs, whether interest rates are going up or you have a period of vacancy that's unexpected and you don't have the physical savings or cash there to do it, then that remaining what we call the war chest, that equity loan, interest only, that's got that additional capacity, can be almost used like a credit card in the context that, if you're not spending it, no cost. If you do need it for certain periods, then you've got that to fall back on without putting yourself under financial stress. So can't emphasize enough the real importance of creating that rainy day reserve, using the equity that you have that's sleeping in your existing properties to fund that, so you're not having to put your hand in your pocket with actual cash, and therefore removing that stress barrier in relation to that ongoing affordability piece. So some really good points made there. Thank you, Rusty. Now, just to sort of bring this to a head then, any final concluding thoughts on this subject, Rusty?
For sure. So I'll probably say two things here. Like, first of all, like, lots of people are getting too much pressure what they're already holding, but at the same time, there are lots of people out there who are really trying to take advantage of this imbalances in the market. And then they're also conscious that there's so much pressure of holding the property, especially with the risk involved, just like what we have been talking about, interest rate rises, the tenancy risk, bad tenant and whatnot. And I would always argue that certainly there are risks in investing in the property. There are always risks. Let's not be blind to them. Let's be aware of them. Let's be educated around them. What are the risks? Let's also understand what those risks are and how do we go about mitigating them. But then bigger than that, there's also a risk of not investing. So let's go back to your why you really want to go and invest, make your money work harder and build wealth. And what if you can't really achieve that? So to me, that's a far bigger risk, which is very hard to handle. So to me, there are risk of investing and risk of not investing enough. So there has to be the right balance. And second point that relates to that is basically there has to be a personalized strategy for each and every individual, like where they are in their financial wealth or financial journey, where they are today, where they want to end up, and how much risk they can take, as in terms of their appetite, in terms of their tolerance, as well as their willingness, as well as what they can do, what they are really holding, and then come up with their own personalized strategy, rather than just getting too bogged down with this something called analysis paralysis. Of course, I'm not really saying that we should certainly be analyzing each and everything, but let's really understand from the context of risk of not investing as well.
A really important point, because as you and I know too well, those that rely on the old Australian dream exercise of just paying off their home loan and putting money into super are going to end up in penny pinching poverty when they get to the point where they decide they're going to stop work. So I think the risk of not investing is actually far greater than the incidental affordability risk that we've been talking about. So I think you make a really good point. And it's really important for investors to build it all out on paper before they commit, so they understand what the true growth and cash flow affordability pieces of a property are before they start, rather than buy the property and then try and work out how it's going to work. So and I know that the work that you do with investors is well attuned to really laying out that turf and making provision and contingencies for all those things that we've spoken about, so they're never actually putting themselves in a position where they're going to be in financial stress. So look, again, Rasti, I want to thank you for these very timely insights, and it certainly reinforces the importance of investors focusing on affordable growth and the real sense of utilising your suggestions to better manage the cash flow while a property does grow in value to achieve their needs without impacting on their hard-earned salary savings or restricting their lifestyle. So if anyone listening wants to explore their personal options with you further, Rasti, what's the best way for them to do that?
For anyone who would like to talk about their own journey, where they are today, where they want to end up, I'm more than happy to catch up with them on one-on-one. They can really jump on my website, which is getrare.com.au/ready, as in READY, for them to book a time one-on-one with me, because that link would actually expose my calendar link, and they can happily, without any obligation, can choose to have a one-on-one chat with me. So the link again is getrare.com.au/ready.
Perfect. We'll make sure we put that in the show notes so that they can book in to do a readiness call with you. And again, I'll reinforce that. It's getrare.com.au/ready. So Rasti, thanks again. We'll make sure we've got all of that in the show notes. And I also suggest that anyone who's interested in taking their property investment to the next level needs to join you on one of your free and very informative upcoming Financial Freedom live Zoom workshops, which anyone can register on for now. Again, on getrare.com.au/financial freedom. That's getrare.com.au/financial freedom. So thanks again for joining us here on the Property Hub's Realty Talk Show, Rasti.
Thank you so much. Thanks for having me.